where do we stand? Very quickly. The banking union has several pillars. We have first the common rule book. And this is the common rule book for banking, the key pieces, the CRD4 and CRR, so the rules on capital and liquidity and governance of banks. There one has to say we have voted and now are in the implementing phase of the rules of the first pillar, but there's about 100 of delegated acts to come. And this is the detailed rules which will be published by the EBA, the European Banking Authority. And I would like to already issue a plea to everybody who is active in the financial sector. I tell you very openly, already these laws were 600 pages of law. For an MEP, it is already beyond what you can really digest in detail. I try to be really honest and direct. But when it comes to the delegated acts, it is really beyond your means. And put it directly, we do not have the staff, we do not have the experience, and I have the impression also many in the financial sector have not anymore the capacity to digest all this. This means, while in legislation, the European Parliament and the Council have the right to draft and change the legislation in detail, when it comes to the delegated acts, we only have a yes or no power. So we can refute delegated acts when they do not correspond to our wishes. But realistically, the European Parliament has not the resources, and individual MEPs even less, to analyze these proposals in detail. So therefore we are absolutely dependent on signals coming from stakeholders telling us where there are problems. And the issues where I'm most interested in, me personally, but colleagues interested might be in other issues, is where the proportionality principle is violated. I tell you very openly what I fear. The more detailed the rules are, the more this will cause problems for smaller market actors. A large market actor can digest these rules more easily. They can share the costs over a large balance sheet of the regulation, but smaller actors, they might well be killed if these rules are not proportional to size and to the complexity of the business model. The law says very clearly that these delegated acts have to be proportional, but they have to hold the test. And bureaucrats have a tendency that they have spelling problems with this word of proportionality. So therefore, I'm very interested in any hints during this lawmaking process of the delegated acts. So then, some of the key consequences of the Basel proposals are still not in the implementing phase. So the liquidity rules and also the leverage ratio will partly only be detailed in the delegated acts, although they are really critical. And this is also a process we will be following. And I tell you very openly my personal assessment. There was huge resistance from some parts of the financial sector against the the leverage ratio. The leverage ratio is a simple and blunt tool. It has a big advantage. If you are skeptical of states to regulate in detail financial matters, and I personally belong to the ones who are equally skeptical towards the state and the financial market. So, and if these two trust each other, it's even worse. Yeah? So I'm very skeptical whether they are, whether the state is really the best actor to assess or claim to be able to assess better what market participants do. So therefore rules, in order to work, public rules, must be simple and blunt. They must not be over complex. They must not be over complex. Monsieur de la Rosière, c'est un plaisir de vous voir. He is the big master of all this. So he's behind the scenes. And anyway, I don't say too much, but I'm very proud that you were coming. So thank you. So for the younger ones here, he was the director of the IMF and has written the key report after the crisis, which will lay the ground for also the supervisory changes in And we tried to implement and met a lot of political difficulties because many of the member states were not ready to really implement these rules. But I come to the supervisory recommendations soon. But I would here like to stress that there is the big danger that we draft very complex, detailed rules which will offer lots of possibilities for circumvention. We have seen that internal models, which are the basis for the capital adequacy rules, that these internal models are very different from bank to bank, that they have been used a lot in order to lower capital requirements, and therefore I think a stronger and stricter and leverage ratio would be in the interest of good regulation. And the 3% leverage ratio is basically far too low. I personally have difficulties talking to industry in Germany. I talk to real world industry. If they would come to a bank and say, I have 3% of capital, of own funds, of my balance sheet, would you give them a credit? No one would. They wouldn't receive they wouldn't receive a credit at a bank. Why cannot banks hold more capital? And I don't only speak about a part of the banks, but all banks. I don't understand why Deutsche Bank has only 3%. Before the crisis, they had 2.4% of own funds to their total balance sheet. Now they have 3%. They are extremely proud. If I talk to world-class industry in Germany, they are laughing about 3%. This is not under its base, and this is an implicit subsidy of the public towards institutions which are undercapitalized. And therefore, I think we should be much tougher when it comes to these simple and general rules, and much more prudent when it comes to over-complex, detailed regulation, which in the end the state will not be able to supervise. But that's my general remarks. Then we created the European system of financial supervisors. This was based on the de la Rosière report in Europe, and we created one supervisory authority for banks in London, one for markets in Paris, one for insurance in Frankfurt, and at the European Central Bank we created the European Systemic Risk Board, which is supposed to work on macroeconomic supervision, while the three others are working with the single institutions and micro-financial supervision. We created, are about to create, the common banking supervisor at the ECB, and there some problems already start, because not all member states of the EU wanted to join this common banking supervisor, and therefore the common market will now be split. There will be the banks with their headquarters in the Eurozone, plus countries which want to join this common supervisor. At the moment there are none, but in principle it's open, and the ones who are outside. And in particular, of course, London, which is the most important financial center in the European Union, will stay outside. This creates a difficult situation because, of course, a lot of business in London is again done by banks which have their headquarters in the Eurozone, so that the common supervisor has a de facto effect on London, which causes a lot of headache in London. So therefore, we have now created a common banking supervisor at the ECB, but it's not for everyone, and they are now about to take over banking supervision from the national supervisors, in principle for all banks, but de facto only for the largest 120 plus banks. The smaller banks will mainly be supervised still by the national supervisors, while the ECB has the right to take over their supervision if they want, if they see need for that. Well, in order to take over the supervision, at the moment the asset quality review is ongoing, as well as a new round of stress tests, which will then be triggered afterwards, so that the new supervisor can be more or less safe, that it doesn't get too many cuckoo's egg into their basket. because obviously it would harm the reputation of the ECB as a supervisor if many banks would be handed over and then shortly after there would be bigger supervisory problems. So therefore now for the first time they try to do a fully fledged asset quality review, although everybody knows that this is something which is not easy to do. It is much easier to make a blunt stress test than to really look into the assets where you have lots of valuation problems.